Hello, investors. It's Don Vandenbord, senior portfolio manager with Revere Asset Management. Today is Tuesday, May 16th, 5:13 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, large cap uptrend. Really tech-led large cap uptrend. We're going to go over the Titan 25 today, seeing some weakness there at some of the lower end of those stocks. We want to take a look at those, continuing avoiding commercial real estate and regional banks, as not a whole lot good is going on there. I talked about the attempt by small caps yesterday get back above their 21-day moving average, and they failed miserably in that effort today. You can see over here at the trend gauge, we've got leaders, neutral, leaning bullish, leading stocks still holding up better than the overall market despite some hiccups. One that we detailed last night about sizing correctly didn't have a good reaction to earnings. We'll talk about that also. Short term, we're at neutral. The S&P 500 closed below the 21-day moving average today, just barely. The Dow had its second close below. Medium term versus the 50-day moving average, Dow broke below the 50-day today also. S&P 500 and NASDAQ 100 still above it. Long term versus the 200-day moving average, the three large cap indexes still above the 200. Mid and small caps continue to struggle. So what happened today? We had a weak retail sales before the open, so that hit the futures. We gapped down, not terribly, down about between 0.2 and 0.5% on the indexes, a little worse on small caps. It really stayed in a tight range today until after 3:30. There was a 3 o'clock meeting with the quote unquote brain trust of Capitol Hill and the White House, and they came out of that saying that they had not reached a deal. Really not a surprise, but the market sold off on that. Had been holding the 21-day until that, so we broke below it into the close. We took off some UPRO on that weakness. After the close, some press conferences were held and actually sounded a little bit more optimistic. So if we get back above the 21 and break out of this 8-day range that we've been in, we can add back some index longs. We booked our last, as I said, sold the last of UPRO for a 9% gain. That was something that was put on when we first climbed back above the 21-day moving average. We were still below 4,000 at that level. So late weakness hit, putting all of the indexes except for the NASDAQ 100, which was strong all day based on the FANG stocks and semiconductors, although semiconductors faded a bit into the close, and actually the SOX and the SMH finished negative. Bottom line, here are the numbers. RG7, this is our 7 ETF growth proxy. Composite down 1.44%. S&P closed at the lows of the day down 0.64%. NASDAQ held on to gains. Dow down 1%. Didn't get any help from Home Depot reporting earnings. This is one of the top 5 Dow stocks. And although it bounced off the lows, it's still down, closed down 2% on the day, although 2% off the lows. That's one we want to keep an eye on, because really, if weak retail sales continue to come in and retailers report weakness, we need to see how much of this perceived weakness has been already baked into the cake. So retail, on the back of that, retail sales and the Home Depot report was weak across the board today. Definitely something we need to keep an eye on, because it does continue to seem like only semiconductors and the FANG type stocks are immune to the looming recession. Mid caps down 1.4%. Russell 2000 down 1.4%. Global diversified 60/40 stock and bond down 0.58%. Bonds weak again today, although reversed some of their losses late in the day, especially on after that 3:30. We had a kind of a sharp break up. In-house GROTECTION down 0.77%. We got hit by ON, gapping down on earnings, but somewhat rescued by good performance out of AMD. NVIDIA pretty held up well too. Celsius had a decent day. Microsoft had a decent day. Meta was flat. So some of our tech earnings offsetting, or tech holdings offsetting the weakness in ON, which we trimmed to just under a 4% position going into earnings. Let's revisit that right now while I have it fresh in my mind. So this is the chart that I laid out yesterday. The expected move at the close, we closed at 33.44. The expected move was $4.20. That's a 12.5% move. The initial reaction was a gap down. The low was 29.10. If you subtract a one-time expected move, $4.20 from 33.40, you get 29.20. So we sold all the way down to the one-time expected move, and then we had a slingshot up to 36.39, a little less than a 1% move to the upside. So in a matter of 30 minutes, we moved down 12%, up 10%, and then started to sell off as we approached. This was all happening before 6 a.m. Eastern time. And then we started dripping back towards flat, bounced a little bit, but opened up negative. And then the two co-CEOs came on CNBC and talked a little bit about some excess inventory that they had, and any hope of a recovery, I think it was down about 6% at that point, uh, was thrown in the trash can, and we trickled down lower. We took off 60% of our remaining position, so we're down to a 1.5% our initial buy, and that last sale was basically flat. And we'll see. We're still holding a piece of it. I'll show why when we go through the charts, but um, this exercise did its job. We do it every time we have a position with gains that is going into and a strong chart and strong fundamentals that is going into an earnings report. So it won't be the last time you see this exercise. It's been a while since we've done it because of the type of market that we're in. So where are we? Moving on. Let's go to the indexes now. And here's your S&P 500. You can see from here, still in this tight 8-day range. Let's go to the 30-minute chart. Day 1, day 2, 3, 4, 5, 6, 7, 8, and actually double inside day, which means today was inside of yesterday's range. Yesterday's range was inside the day before's range. We're bouncing a little bit after hours, I believe, because of those positive comments made at the press conferences on the debt ceiling uh, situation. But as I said, we did close our UPRO, which we bought at under 4,000, booked that gain. Still holding some SSO, small losses on that. Most of that was bought but around 4020 area. Sorry, 4120 area. So we'll see where we go with that if we reclaim the 21. But more importantly, we want to break out of this range. You can see how tight we are, 4,100 on the downside, and then you've got declining tops trend line from 41.55 down to 41.40. We want to break through that trend line. That's what the bulls want to see. What's the catalyst going to be to do that? Is it going to be debt ceiling finally being resolved? That's one possibility. We could also see a break to the downside through 4,100 if these negotiations continue to drag on. Janet Yellen did her best to panic everybody before the market. That added to the pre-market losses, and then we also had a bunch of Fed speakers talking today, and as usual, they're saying they have no plan to decrease interest rates, drop interest rates into the end of the year, while the market continues to price in 2 to 3 interest rate cuts. So we'll see where that goes. A lot of cross currents going on in the market. For now, we remain in this tight 8-day range on the S&P 500. The Nasdaq 100 continues to outperform, making higher highs. If this were to give way, the markets really are in for uh, a bad time of it, and that's why we kind of have one foot out the door with everything that we own, keeping our eye on our cost basis, on the gains, on how extended it is versus the moving averages, and uh, the overall tenor and tone of the market. You can see Nasdaq 100, of course, continuing to outperform. What's not outperforming now is the Dow Jones Industrial Average. You can see the held the 50-day moving average for 3 days, ran into the declining 8 today. Uh, Home Depot gapping down, new closing low going all the way back to the end of March on the Dow, and you can see the relative weakness there. It's very typical that you see relative weakness on the Dow when you see relative strength on the NASDAQ 100. Let's go to mid caps, which continue to struggle. You can see this big declining tops trend line right in line with the 50-day moving average and the 21, which is right below that. So making a series of lower highs and lower lows. That's pretty much your textbook definition of a downtrend. Here, small caps, more jagged, but actually looking more like a base than the mid caps are. But of course, yesterday, as soon as we ran into the declining 50-day moving average, despite the one close above the 21, we reversed, gap down, closed near the lows of the day today. This 172 area, you can see we've shaken out a couple times below that. But that's been providing support recently. A move below that 172, you've got 170, and then not a lot of support all the way back to 162. So that's something we're keeping our eye on, as well as the possibility of taking a short against this index if the weakness continues. Really, you don't want to short in the hole, which means short a breakdown, because you get situations like this where you break down, you think you're in good shape, and you just get too oversold and you slingshot back to the upside. If you're going to short, you don't want to already be in oversold territory. That's called shorting in the hole, and that's a recipe for disaster. You do not want. Here's another example: shorting in the hole. Where was the stochastic already oversold? How oversold do you want to be? The odds aren't in your favor at that point. So you see the slingshot up, ran into resistance and started to roll over again, and then the stochastic rolls over again finally as the trend of the last 14 sessions turns negative. Small caps, let's go to KRE, which started out the day nice. We started out higher above the ADMA, above yesterday's high, but just trickled lower most of the day. Here's the gap up and a little bit of strength early, but then we start making lower lows, lower high, lower high, lower low, lower high, lower low into the close. Not a good close on any of the indexes. So KRE again failing at the 8 EMA. Let's look at XLF, primarily bigger financials and insurance and banking and asset management, but this can't get back above the 21-day or even the 80 MA. You can see how this continues to be in a downtrend. Let's see what's next. The dollar. I remarked on Friday that the dollar had broken out, and that is not good for stocks. We had a tight inside day yesterday, another up day today, and this is not good for stocks. Another reason why we've got one foot out the door on every one of the positions that we have. You can't fight a strong dollar. The market just doesn't beat it. And this strong dollar, again, really got to the gold stocks today, breaking the 21-day moving average, down 1.25% on GLD, gold stocks GDX, breaking the 21, coming into the 50, down 2.65%, SLV, down 1.31%, breaking the 50-day moving average. You can't have a strong dollar and strong precious metals. That's just the inverse correlation that has typically holds with the market and certainly has held recently. Next up, the VIX. VIX popped a little bit, especially into the close, closed above the 21, still in the tight range below the 50-day moving average. In this same tight cluster that the indexes are in. If it breaks out of this cluster, you're going to see the indexes break below the bottom of their cluster. Let's go to bonds now. Bonds down, but did finish at their high prices of the day, although lower. Let's take a look at a 5-minute here on the BND. This is the broad market index. You can see the gap down, lower low, uh, late morning, and then just trickling higher throughout the day. Let's go to TLT. Uh, Gap down, lower, and then just slowly working its way higher. Here is where the debt ceiling announcement came out. You can see a strong close on that. You're not going to see that on the rate charts because they close at 3 o'clock. But you can see the gap up here and giving up most of it after a mid-morning high on the 10-year and also on TYX, the 30-year, dripping lower, not quite filling the gap, but it would have come close if we'd have continued if this traded after 3 o'clock. So those are the bond indexes, and you can see this breaking out of this recent range. This is the 30-year yield to the upside, which means you're going to see TLT breaking out to the downside. It's actually just at the lip of this recent range that it's in. So our uh, long bond ETF is on the edge of triggering the stop below today's lows. Is the stop for that on the TLT. Let's get now to Bitcoin, which gap down 1.8% today, still on the edge of this 16 area. You can see on a 60-minute chart that has been the bottom end of this range, ran into that. So this is a case where what had support may have flipped to resistance now, trying to get back inside that 16 range, tried to do it here, failed, tried to do it here, failed, tried to do it here, failed, and uh, for now 16 has now flipped from what was support here, support here, support here, to resistance on Bitcoin. So those are, did I show them all? Yes, I did. No, let's go to two. I want to show the equal weight index for the S&P 500. Looks terrible, below all the moving averages. So it's very clearly only XLK tech stocks, XLC, XLK, XLY that are holding the S&P 500 above their moving averages. The equal weight looks awful. Coming into oversold though on a daily chart, which again, you can stay oversold for a matter of weeks. You can see it here, even with a false start, oversold for 4 weeks there. That's the RSP, QQEW, the equal weighted NASDAQ 100 sitting, just going sideways, basically treading water, staying in line with the return of the S&P 500. It also has hooked lower on its stochastic. We've got an alert there to tell us if it breaks the 50-day moving average. Thinner and thinner leadership across the market. It was like an 85% down day today, even with the indexes before they had that little spurt lower in the close. Fewer and fewer stocks holding up. We'll get to the Titan 25 momentarily. Let's bring up the tail of the tape now. Stochastics back to neutral. This is a problem. The strong dollar. Watching that closely. That stays strong. It got to precious metals today. Finally breaking below their average. It got to the 21-day moving. The S&P at the 21-day. It got to the Dow. Strong dollar's a problem. We're another close below the 21 on the S&P will take us off of this bull case. There's the comments that I already made on the news, retail sales, the debt ceiling. I mean, no agreement at debt ceiling meeting, obviously. Day count from a 7-day consolidation to basically one up day and then a 7-day or 8-day consolidation. First close below the 80 EMA on the S&P 500 and the 21 EMA. Will flip to neutral or on if the S&P gets its second close below the 21 and breaks this tight range that we're in. Here, the only sectors that were up today, the dollar, tech, really led by FANG, and bond yields down. Semiconductors were strong until the close. KRE started strong and faded. Gold, precious metals, retail, biotech, oils, solars, materials, utilities, and real estate all weak on the day. So not good stuff there. As far as the portfolio, we trimmed ONON down to a 1.5% position. We added a percent to Uber, and we sold UPRO on the close below the 21 today. Bottom line, late weakness on the debt ceiling fears. S&P 500 breaks the 21, Dow breaks the 50-day moving average. Let's see what tomorrow brings us, and let's get to some charts now. And we're going to show the Titans, but first we're going to show what was impacted in the portfolio. Uh, we'll give one last look at ONON, and the reason is on the weekly, I talked about where it stopped going down around this 29. The pre-market low was 29.10. During the market session, the low is 29.62. That roughly coincides with the 10-week moving average and the 50-day moving average. Now, going back to William O'Neill rules, using the 10-week as a support area is one of his hard and fast rules. I hear countless times for people that take a little bit longer term view of the market that if I'd have just held through the 10-week and the 50-day for the entire run, I would have made a whole lot more than if I traded out on breaks below shorter term moving averages. So this is why our initial buys on this were back here in the 26, 27, 28 area. We took gains when it broke 30. We got back in at 30.20. So these booked gains, if you add up what we sold yesterday and what we sold prior, we're still very much up on the position. So we're going to give it a chance now. We've got the 50-day moving average. Another thing that you always want to see is the 50-day moving average above your initial cost basis. And again, those first buys we did 26, 27, 28, 29 area. The 50-day moving average is above there. So that last 1.5%, one of our rules is try to make that last sell, make the market take you out at a true breakdown. And a true breakdown is a high volume close on a week below the 50-day moving average. We don't have that yet. So we're still profitable if you consider booked gains on this last piece of the position that we own. It's still holding the 50-day and the 10-week. Let's see what the rest of the week brings us. This is a very strong stock. They've got great fundamentals. They actually upped their guidance on the year. A comment about fundamentals that they made, or inventories that they made, caused that last bit of a sell-off. Let's look at a 5-minute chart here. It was recovering very nicely. This was the time on CNBC when they came on and made that comment about the inventories. It's possible that this 5-minute chart here, where the 539,500 shares were blown out, was somebody's massive stop getting hit. It didn't break 30 the rest of the day. It's trading in a tight range, so 30 is a key area also. And you've got the 50-day moving average at 29.43, which is below the low of today. The 10-week a little bit lower relative to the 10-week, which is at 30.71. We closed 50 cents below that, but we want to see where we close the week, and then we'll hold on to that last piece of the position on ONON until that final sell is violated. So that's ONON. We added to Uber. When it undercut, regained the ADMA, closed back below the ADMA intraday. So tight leash on that one also. And then we sold UPRO with the close below the 21 on the 50-day on the S&P 500. NASDAQ 100 is still an XLK, XLC, and XLY. Let's go through the three of them. Call them Chucky, XLC, XLK. These are what's holding up the index. Primarily XLC and XLK, but Amazon had a very nice day today. That's the biggest holding in the XLY, although Home Depot is a pretty big holding too, but not quite as big as Amazon, not even near as big as Amazon. So let's go to the 25 over 25. Where are you? Okay, here's the 25 over 25, and I said we've gotten a little bit weaker. So uh, here here were the numbers as of last Friday. We had 12 positive, 9 neutral, 4 negative. As of today, we've got 11 positive, 8 neutral, and 6 negative. The negatives are pretty clear to see here. They stand out in bright red: United Healthcare, J&J, Exxon, um, Goldman Sachs, Home Depot, Amgen. Amgen had an acquisition challenged today. I don't know if it was domestic or over in Europe, but that hit the stock pretty hard. And Caterpillar looks awful. So we've got 6 that look negative, meaning they are more than 2% below their 21-day moving average. And then we've got 5 that are more than 4% below their 50-day moving average. Relative to the 21, um, we've still got 9 more than 1.5% above their 21-day moving average. We've got 5 that are between 1.5% and a 1% loss. We've got 1 that's between a 1 and 2% loss, and we've got 7 that are below 2%. On the 50-day moving average here are the numbers. We've got 11 still, and they're crowded at the top. These are the biggest allocations of the S&P and the NASDAQ 100. Notice they're not that big an allocation of the Dow, and that's why the Dow has now broken its 50-day moving average. The biggest position in the Dow is United Healthcare, and that's a negative. So we've got 11 stocks still 3% or more above their 50-day moving average, stacked at the top. Tesla, the only weak one, 6.8% below its 50-day moving average. So again, a little bit more weakness, but not breaking down on the NASDAQ 100 and the S&P, and it's because of these. So we're watching these stocks like a hawk. If these start to break, we'll be shorting the S&P, we'll be shorting the NASDAQ, and be moving to cash pretty quickly, because a handful of stocks can't hold up the market indefinitely, and it seems to be getting a little bit worse. So with that, we're going to wrap it. As always, like to hear from you. Active management is what we do at Revere because we want to avoid these bear markets. They all occur below the 200-day moving average. We're still above the 200-day moving average on the S&P 500 and the NASDAQ 100. Um, that's basically the bulk of the market, and we break below that 200-day moving average level. We're still 3% above it on the S&P. That's where these bear markets occur, and they can really get ugly. So our number one mission is to avoid these, and when the market gets back to healthy, and it historically it always has, we're just waiting for a fat pitch, whether it's going to take a debt ceiling agreement or a mild recession and some better numbers to come in from uh, companies that report same store sales, et cetera. Um, don't know what the catalyst is going to be, but this tight range has got to break one way or another, and we've got a plan to cover either. If you're interested in this approach, email me, don@revereasset.com, or my partner, Dan Stewart, dan@revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. And with that, I'm going to wrap up the Tuesday 5/16 edition of the Revere Market Insight video. Thanks for listening and have a great day.